Passive income is sold as a dream. Make money while you sleep, retire early, and live free. All you gotta do is buy my program. But here's the truth. Passive income is not about making some extra money so you can finally afford to pay your bills. Instead, passive income is about taking your extra money and using this extra money that you have to buy the right assets that can then give you a second, maybe a third stream of income that pays you while you sleep passively. In this video, I'm going to show you how to stop chasing that fake passive income that keeps so many people broke, and then I'm going to show you how to start generating real passive income the right way. Let's start with the foundation. Passive income is not creating a job for yourself. It's not going out and building an e-commerce store or starting a YouTube channel or a podcast or starting a side hustle or building some AI tool. These things require work. They are active. They are things that create new income, but it's not passive. What passive income actually is, it's when you take your extra income and you take this extra money and you use it to buy an asset that's going to pay you with cash flow. Maybe it pays you every month, maybe every 3 months, but it's going to deposit money into your bank account regularly without you having to sell this investment. And there are ways to purchase this type of passive income by buying stocks, by buying ETFs, by buying real estate, and by investing your money into certain cash investments. With these types of assets, you don't have to actually go to work to get paid like you'd have to do here. And you don't have to wait to sell your investments to get paid. Because they are cash flow investments, you're going to get cash deposited into your bank account, again, either every month or every 3 months, just for owning the right investment that you don't have to actively work to operate. I'm going to show you how you can start investing for this type of passive income in just a minute, but there are 4 reasons why I personally like investing for this type of cash flow. Number 1 is you don't need a ton of money to start. You don't need $1 million. You don't need $100,000. You don't even need $1,000. You can start investing for this type of cash flow with as little as really $100. Number 2, you don't have to sell your investments to get paid. This is one of my favorite parts, is I can just work to stack assets and never have to sell because each asset slowly starts to pay me some more money. And number 3 is if your cash flow from your passive investments exceeds your expenses, well, now you are free. Because now you have enough money coming in from your investments right here every month to pay for all of your bills, to pay for your mortgage, to pay for your car, to pay for your groceries, to pay for your vacation. Now you no longer have to go to work to get paid. You can go to work to buy more assets or go to work because you love it, but you don't have to go to work to keep paying your bills. That's what real wealth is, because now you have freedom. You have cash flow coming from your investments that covers your expenses, and now you are financially free. It's not going to happen overnight. It's not going to happen in a year. It could happen in 10 years. It could happen in 20 years. It could happen in 30 years, depending on how aggressive you are, but it can happen if you are willing to go through the work and make the sacrifices to make it happen. So let's go through how you can actually do it, specifically going down the list from stocks through cash. Some of the largest companies in the world, like McDonald's, trade on the stock market. In the stock market, McDonald's is known as MCD. This is the ticker symbol, meaning abbreviation for McDonald's. And some of these companies are making huge profits. Like in 2024, the McDonald's Corporation made a little bit more than $8 billion of profit. This is how much cash they had in their bank account after paying for all of their expenses. And when McDonald's makes $8 billion worth of profits, there are 3 things that they can do with this cash. Number 1 is they can save this money for an emergency. In case we enter a recession, in case we see some sort of bad things happening in the economy, they have some cash saved up. That way they don't have to go out of business immediately. Option number 2 is they can reinvest some of this money, because they can take this money and invest it into new hamburgers, into new locations, into new technologies to make their company more profitable and to produce a better product. Or number 3, they can also just give this profit away to their investors, to people that actually own the McDonald's Corporation. And what you'll see a lot of the big companies do that have big profits is they'll do all 3 of these things, because they can't reinvest all this money because they're already so big. They are not interested in aggressively growing. They just want that slow and steady growth. So they'll reinvest some, but not everything. And they'll also want to save some, but they also don't want to save everything because, well, saving money is not very exciting. And that's where some of these corporations will just give this money away. And one of the ways that these corporations on the stock market give this money away is in the form of a dividend. A dividend is a cash payment that a company is going to give you for doing nothing except owning the stock. And in the stock market, generally, companies that pay out dividends will pay you a dividend every 3 months, meaning every quarter. Now, not every company is going to pay out a dividend because not everybody has a profit, and not every company is interested in giving away that profit. But the companies that do pay out the dividends are generally paying them out every 3 months. And in order for you to qualify to receive that dividend for yourself, you have to own one of the shares of the company. So let me show you how the McDonald's Corporation works. So let's assume this pie right here represents the McDonald's Corporation. And what they do is they'll slice up the pie into many small slices called shares. And in McDonald's case, they have approximately 710 million shares of the company. So if you wanted to go out and buy the entire McDonald's Corporation, you'd have to go out and buy all 710 or so million shares. But you can go onto the stock market today and purchase one share of the McDonald's stock, so one slice of their pie, for approximately $300 per share at the time when we're recording this video. Why does that matter? Because also today, at the time when we're recording this video, McDonald's says that they are paying out approximately $7 in dividends a year for every share that you own. So if you go out and buy one share of the McDonald's stock, you're going to be entitled to $7 of cash flow for every share that you own. Now, to put that in perspective, there's about 710 million shares of McDonald's. Each share pays out slightly more than $7 per dividend, which means McDonald's is going to be paying right around $5 billion of dividends out this year, out of the $8 billion of profit that they generated last year. So you can see how they're going to be giving out a big chunk of these profits, and you can get your share of the profits if you own one of the shares of a company that's paying out these dividends. Now, I'm not telling you to go out and buy the McDonald's stock. I want you to understand how this works because I'm going to give you some more specific examples in this video. And I do have to remind you that investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Everything that I'm going to show you in this video is for example purposes only. I'm not telling you what to invest in. So if you buy one share of McDonald's, you'll have to spend $300 to make $7 of cash flow. If you buy 10 shares of McDonald's, that's $3,000, and it'll pay you 7 times 10, $70 of cash flow. Now that might not sound like a lot, but you have to remember, this cash flow game is a long-term game because you want to invest in a company that's not only growing in value, but where they're also paying you more cash flow every single year. For example, a number of years ago, the McDonald's stock was trading for around $100 a share. And at that time, around 10 years ago, the McDonald's stock was paying out around $2.80 per share, which means over the last decade, not only did the stock price grow by around 200%, but they've also increased the amount of dividends that they're paying by 150%, which means for every share that you bought years ago, not only is a share more valuable, but you're making more money out of every share that you bought years ago as well. So if you're working to accumulate more shares, not only are you getting more income because you have more shares, but each share is paying you more income year after year, assuming you buy a good asset. So let me actually break this down with some more examples. Morningstar recently published a list of their 10 best dividend stocks to buy. I'm not recommending these, I'm just showing you how to think. And the top 3 that they say are Merck, Coca-Cola, and PepsiCo. At the time when we're recording this video, MRK is paying out a dividend of around 3.85%, meaning if you were to invest $100 into this stock, you're going to make $3.85 of dividends in cash flow this year alone. Coca-Cola is paying around 3% a year in dividends, and PepsiCo is paying out around 3.75% a year in dividends today. Now, if you look at these numbers by itself, you might say, my goal is cash flow. I want to invest in the biggest dividend, so clearly this is the best investment. But that's only one part of the equation, and this is why it's so important for you to understand the investment that you're making. Take a look. Over the last 5 years, the MRK stock is up by around 11%. Versus the Coca-Cola stock over the last 5 years is up around 30%, even though they're paying out a smaller dividend. So yes, today Merck is paying out a bigger dividend compared to Coca-Cola, but if we take a look at the actual stock, the actual investment over the last 5 years, Coca-Cola has way outperformed. And this is where if you can invest your money into a good stock, now you can see the value of the stock go up and see the value of your dividends go up as well, because as the share becomes more valuable, the company is probably making bigger profits, and if they're making bigger profits, they can pay you a bigger dividend as well. This is why when you invest your money for the cash flow, you have to go beyond just looking at this percentage dividend, because most people are looking at this thinking that, oh, the bigger the dividend, the better the investment. But if the investment is trash, well, Now the dividends become pretty trash too, because over time those dividends get smaller if the company is making smaller profits. This is why it is so important to know how to analyze your investments instead of just blindly throwing your money into a random stock that you read on the internet or into a random stock that a random guy on the internet told you. You need to know how to analyze your investments. And if you want some more help on how to do that, again, I put together a brand new free investing masterclass where I walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. Plus, I'll show you the exact framework that my firm and I use to research investment opportunities before they hit the headlines. It's a completely free masterclass. There's a ton of value in this masterclass. And when you register for it, you're also going to get access to Market Briefs, which is my newsletter for investors, for free, complimentary as a bonus. So if you want to get the investing masterclass and Market Briefs all for free, all you have to do is register, and I have the link for you down in the description below. Now, this is where a lot of people say something along the lines of, Jaspreet, this is cool, but now I'm starting to get a little bit overwhelmed. I don't know how to analyze a stock. I don't want to research the financials. I don't want to study what the CEO is doing. Isn't there a simple way for me to just invest for cash flow? And yes, there is, which is why number 2, we're going to talk about ETFs. So let me show you how you can get this type of cash flow without having to do all that same work. This is where ETFs come into play. An ETF is an exchange traded fund, and this is where you are investing into a basket of stocks. So what we talked about before is the value investing into an individual company. We talked about McDonald's, how McDonald's makes billions of dollars of profits, and they can give away some of these profits at the end of the year in the form of a dividend, which is cash flow that's deposited into your bank account every 3 months. Well, if you don't want to research that company or don't want to take on that additional risk, what you could do is invest into a fund, into a basket of stocks that may look something like this, where now instead of just investing in McDonald's, you invest in McDonald's, AT&T, and Apple, and Tesla, and Coca-Cola, and Amazon, and Nike, all into this one fund. This way you don't have to find all these stocks, you just find this one fund that's giving you exposure to all of these stocks. Now, the nice thing about this is you don't have to worry about doing all that research, because in this case, if McDonald's were to go bankrupt, well, you lose your entire investment. Your investment goes down to zero. In this case, if McDonald's went bankrupt, yes, it would hurt the fund, but then the fund could automatically kick McDonald's out and replace them with a new company. Maybe they'll replace McDonald's with Chipotle. Who knows? But this is passive on your side because the fund is actively working to manage the fund, and you don't have to do any of that work. So it's less risk, but also less return. Because in this case, if McDonald's were to take over the world and now they started having these amazing burgers and everybody wants a McDonald's burger, now they're probably going to make bigger profits, and they're going to see their stock price go up and their dividends go up, which means in this case, you would benefit because you're getting all the gains. Here, if McDonald's took over the world, well, it's going to be balanced out by some of the losers in the fund. So you have to understand that this comes with less risk, but also less potential return. Now, there are many different types of funds out there. You can invest in funds that give you exposure to the stock market. There are AI funds, healthcare funds, real estate funds. For the purpose of this example in this video, let's talk specifically on dividend-paying funds, which are focused on providing income and stable income for you. I'm going to go over 4 different types of examples. Again, these are just examples. I'm not telling you what to invest in, but example number 1 is NOBL Noble. This is an ETF that gives you exposure to the S&P 500 dividend-paying aristocrats. What that means is, number 1, to qualify to be in this fund, you have to be a part of the S&P 500. That's a group of the 500 largest companies in the stock market. Then layer 2 is you have to be a dividend-paying company. So you have the 500 largest companies in the stock market, but not all of them are paying out a dividend. And then number 3 is you have to be a dividend aristocrat, meaning not only do you have to be in the S&P 500, not only do you have to pay out a dividend, but you must have also increased your dividend every year for at least the last 25 years. So this is a very exclusive club focusing on the very large companies that have a strong track record of not just paying out a dividend, but also increasing their dividend for decades. At the time of me recording this video, NOBL is paying out a dividend of around 2% a year. Example number 2 is SCHD. This is an ETF created by Schwab. Schwab is a fund manager, and this is focused on investing in high dividend paying companies inside of the United States. So at the time of recording this video, SCHD is paying out around 3.75% a year. It's not as rigorous as Noble, but this is investing in the larger companies in the United States that are paying out higher dividends. As a disclaimer, I am personally invested in SCHD. Example number 3 is VIG. This is an ETF created by Vanguard, another fund manager that focuses on appreciating dividend companies. So VIG is looking for the companies that are the larger, more established companies that are focused in on increasing how much money they're paying out in dividends year after year. VIG at the time of recording this video is paying out around 1.6% a year. And then last but not least is VYMI, another fund that I'm personally invested in. As a disclaimer, this is also created by Vanguard, but this is investing in international companies that are not in the United States that have a track record of paying out strong dividends. So this gives you some diversification outside of the United States, but there's also more risk, because not only do you have the company risk, but now you also have the country risk, because some of these countries are not as established. They don't have as strong of a military. They don't have as strong of an economy, but the company and the country is looking to grow. At the time of recording this video, VYMI is paying out around 4% a year in dividends, but also potential for higher growth and higher returns on the dividend side as well. Now, when you hear these numbers, you might say, well, Jaspreet, this doesn't sound like a whole lot. But the way that you win in this game, again, is by number one, finding a good investment. And what do I mean by a good investment? Something where the asset price will go up and they're gonna pay you more dividends, because the goal is the shares that you buy today are gonna pay you more income next year. They're gonna pay you more income the year after that, and even more the year after that. So you want to own these investments for the long term. Number two is every year you want to consistently buy more of those shares that are paying you that cash flow. I have a system personally where every week money is leaving my checking account and is being invested into my portfolio of funds. So I'm always working to acquire more shares that are paying me more income. I do it every week, whether markets are up or down. I don't care what's happening in the economy. I don't care what's happening in the geopolitical world. Every week that's happening. So number one, I want to buy a good investment. Number two, I'm always buying more of these investments every single week. And then number three, when I get paid with that cash flow, I'm reinvesting that cash flow as well. I'm reinvesting these dividends because I'm working to build a machine that's working to pay me with income. Then as the machine pays me with income, I'm going to use the income from the machine to buy more machines that are going to pay me with income. So you use money to buy the machine, then as the machine pays you, you use that payment to buy more machines. It is a very slow process in the first few years, but I call it a decade of sacrifice. If you stick with it, the first 3 years are going to give you essentially no returns. Year 4, year 5, you start to see a little bit of returns. Year 6, year 7, you start to see some more returns. Year 8, oh, all of a sudden you have a new stream of income. Year 9, now you're starting to see how this machine starts to work. And by year 10, now you have a solid new stream of income if you're willing to put in the sacrifice to stick with it. But most people are not going to make it that far. And then what happens by year 10 is what you'll see is that the shares that you were buying early on 10 years ago now are hopefully worth a lot more money, but are also paying you a lot more income. So every year you're working to acquire more shares, and each share is paying you more income year after year after year. And that means every year when you reinvest those dividends, you're buying even more shares. And this machine starts to compound and become more powerful as the whole system starts to become bigger. That's why it's a slow process, especially in the early years, and most people are not going to make it past, the first 30 days, let alone the first 3 years. But if you can stick with it and make it automatic, it can build a very powerful income producing machine over the course of your career. But you have to be willing to stick with it and not get caught up with the shiny objects of just chasing the high dividends, because a lot of times those super high dividends end up having crashing assets because the underlying asset was not that good. So you need to work hard to spend less and earn more to buy more of those dividends in order for this to actually work and stay consistent with it. So what we talked about so far is that passive income is not actively going to work to get paid. It's not actively building a business. It's not actively doing something. It's taking your extra income, buying an investment that can pay you with cash flow. And we talked about that one of those investments can be individual companies, because some companies, for example, McDonald's, have these huge profits every single year that they just give away to their shareholders. So you can invest in those shares as a shareholder, but it takes more risk and it also takes more work to research those companies. Now, for some people that's going to be fine, but for some of you, you're going to want to just invest in a fund that we don't have to do the work to manage that portfolio itself. And this is where you can research and find specific funds like ETFs that will give you exposure to high dividend paying companies. So we talked about a few different examples to do that, and the way that you win is through a strategy I call ABB. Always be buying. Set up a system, whether it's every week, every 2 weeks, every month, where you just keep buying more shares of these funds, and as you start to get paid from these funds, you reinvest that money until you're ready to live off of that cash flow, or until you want to start spending that cash flow. And I gave you the resource, which is my investing masterclass that I have for you down in the description, to help you find and analyze stock market investments better. This moves us on to number 3, which is investing for cash flow in real estate, which is another thing that I absolutely love doing. And you'll see exactly why, because real estate has some of the biggest and best tax breaks that our tax code has to offer. as a licensed attorney who's not your attorney. The way real estate investing works is not you go out and buy a house to live in yourself. This is what most people think about. Instead, it's you going out and buying a house, buying an apartment complex, buying some sort of property, not for yourself, but to rent out to other people. And it can be very daunting, this idea of buying real estate for somebody else before you have real estate, but stick with me and see the different ways that you can do it, because for some people, maybe your first goal shouldn't be to buy a house to live in, it should be to buy a house to rent out to other people. That's personally what I did. I started investing in real estate to rent out to other people before I bought a house for myself. I did that for almost 15 years, that I was buying rental properties before I actually purchased a house for myself, because I knew that when I was buying this real estate to rent out, it would make me more money than if I bought a house for me to live in myself. Now, I don't recommend what I do to anybody else, but let me show you how real estate investing can be so powerful for the people that think differently. So if you go and buy this house for $250,000, and I know what some of you are thinking, Jaspreet, where can you find a house for $250,000? Well, I'm based in Michigan. My office is in downtown Detroit. If you look around the Metro Detroit area, you can find some great houses just like this listed for sale for $250,000, which you will be able to rent out for right around $2,500 a month, which is pretty nice. Now, $2,500 a month in rental income sounds great, but you have to remember that's not all profit. When you purchase a house, you have expenses. You have to pay for the property taxes. You have to pay for the insurance. You have to pay for the maintenance. You have to pay for the management fees, because I don't want you to actively manage the properties, because remember, I want this to be as passive as possible for you. In the beginning, it's going to be a lot of work, but once you understand it and you build a good team, then it can be very passive for you, because I don't manage my rental portfolio. I have a team of managers that are doing all the work, and they just give me a report every single month of how things are doing. And then you have to cover the vacancies, because there's going to be times where tenants move out of the house and you don't have anybody paying you. So let's factor in some costs. I'm going to round up what I think the cost could be, because I'm not going to be upset if I made more money than what I expected, but if I make less money than what I expected, I'm going to be a little bit more stressed out. So when it comes to your property taxes, let's assume $250 a month in property taxes. Then you have to pay for your insurance, again, another $225 a month for your property insurance. Then you have to pay for your maintenance, and hopefully your maintenance costs are going to be less, but let's just assume about $250 a month factored in for your maintenance costs. Some months are going to have no maintenance costs, some months are going to have more. Then you have to pay for your management fees, because I don't want you managing this property yourself. A property manager might cost 8, 9, maybe 10% of the gross rent. So I'm gonna go with the 10% number. If you're making $2,500 a month in rent, your property manager might take up to $250 a month in management fees, and then you have to pay for vacancy costs. If your property is vacant for 1 month out of the year, well, that's going to be an additional $208 a month in lost rent. Again, it's not an actual fee that you're paying, but I want to factor in that cost, because most people forget that sometimes your property is vacant and you still have to pay for the expenses. Now, when you add up all these monthly expenses, what you'll see is that you are making about $15,800 a year in profit. And right now, I'm assuming that you don't have a mortgage, that you purchase this property all cash. Now, the first question you have to ask is this a good return or not? And this answer is going to depend on who you are and what your goals are. If you take this profit, $15,800, and you divide it by the amount of money you had to put in, $250,000, that's about a 6.3% cash flow. Now, the question is that good or bad? And again, it's going to depend on who you ask. For some people, they're going to say, that's an amazing return. I love the idea of getting a 6% return. For me personally, not good enough. I like to invest in properties that are paying me a minimum of 7% cash on cash returns. So it's almost there, but not exactly there. I like to look for every dollar that I invest, I get 7 cents of cash flow back. Now, the return that you're going to ask for is going to depend on a couple of factors. Number one is the type of properties that you're investing in, and number two, the location of where you're investing. If you're investing in Manhattan or Los Angeles or Miami or some of those really hot areas, you're probably not going to see these 7% returns. You're going to see 1% cash flow, maybe 2% cash flow, maybe even less, maybe even negative cash flow, because people are buying properties in these areas not caring if they make a profit from the rent. They just hope that these properties are going to be worth more money in the future. That's not the game that I play. I like to look for consistent positive cash flow, because again, my goal is cash flow. It's not to hope that these properties are worth more money. That's appreciation. That's not the game that I like to play, especially with my real estate. The second has to do with the type of properties, which also has to go hand in hand with the type of areas that you're investing in. In real estate, you have turnkey properties, and then you have value add properties. A turnkey property is a beautiful house, those cute little houses that come with cute little profits, but a cute little house is one of those houses that looks very nice. It has brand new flooring, brand new carpets, new paint on the walls, new landscaping, new everything, and it looks so beautiful. It's ready to go. It's where you want to live. And because it's already ready to go, you have to pay a premium for that, so your returns are generally going to be a little bit less. When it's an apartment complex, it is a property that's fully occupied, where everybody's already paying rent. It's a fully doing good property. It's turnkey. All you have to do is just walk in. A value add deal is the opposite. You walk into this house and it smells like crap. There's holes in the walls. You walk into the kitchen and there's a rat running around. Those are the types of deals where you're going to get a big discount. And because you get a big discount, if you're willing to put in the work, you can get a better deal. I personally like these types of properties. With apartment complexes or commercial deals, this is where the property is pretty much fully vacant. And it's kind of a drug house right now. And nobody wants to be near this property. You're going to get a big discount on that property. It's going to be a lot more work, more risk, but you have the potential for more upside. These are the types of deals that I have found to give me better cash flow. More work, more risk, more potential return. Not for everybody, but it does work for the right person. Now, a few minutes ago, I told you that real estate is very powerful because it has some of the biggest and best tax breaks that our tax code has to offer. And so let me show you why this can be so powerful. Because when you go to invest in real estate and you make this $15,800 a year in income, you would think that you have to pay taxes on all $15,800 a year in income, which is not exactly true. For the purposes of this example, let's assume that in this $250,000 house, $50,000 was attributed to the value of the land and $200,000 was attributed to the value of the actual house, the actual building. Well, in the tax code, the United States tax code, what it says is when you go out and you buy a rental property that's a single family house, you get to take a depreciation deduction because your property has wear and tear, because it's 1 year older, you get to take a write-off because of that. And when it's a single family house, you find the value of the actual building, in this case $200,000 because we said $50,000 is the land, and then you divide that number by 27.5. Why 27.5? Well, that's just what the tax code says if it's a single family house. If it's a commercial building like an apartment complex, then you take that value of the building and divide it by 39. Again, that's just what the tax code said. I didn't make these numbers up. That's just what it tells you. So in this case, I take $200,000 divided by 27.5, and what it tells me is I'm going to get a $7,200 deduction. Why? Because of depreciation. Why do I get it? Because that's what the IRS tax code says. When you go out and you buy a single family house, take the value of the building, divide it by 27.5, and that's how much of a write-off you get every year for the next 27 years. So I made $15,800. This is how much money is in the bank. I get to take a $7,200 write-off, which means I have a taxable income of $8,600. This is how much money I'm going to actually pay taxes on, even though this is how much money I have in the bank. This is one of the hacks that real estate investors have to pay less money in taxes legally, because the IRS tax code says that you get this depreciation deduction. Now, some investors are going to take this one step further. If you get a savvy accountant, what you can find out is you can do what's called accelerated depreciation. Here, the $7,200 depreciation deduction is the base case. This is what the IRS just gives you. But what the IRS also says is if you can accelerate the depreciation, you can take a bigger deduction in year 1 and year 2 and year 3. So what some investors will do is they'll work with their accountant to say, value of the building is $200,000. In year 1, instead of taking a $7,200 deduction, we should take 10% of the property value, which in this case is $20,000, which means now you don't have $8,600 of taxable income, you have a negative taxable income of $4,200. Now, remember what I said just a second ago. This is not how much money you actually made. You have $15,800 in the bank. You just tell the IRS, hey, I have a loss. We lost $4,200 because of this depreciation deduction, because my property's 1 year older and we did this accelerated depreciation, which means you have $15,800 in the bank. You're going to pay $0 in taxes because in the IRS's eyes, you lost money. And then next year, when you go to file your taxes, you're going to take this loss and you're going to carry it forward to the next year. This is how many real estate investors get to make large sums of money and pay little to no money in taxes because of this depreciation deduction right here. And yes, you can qualify for this depreciation deduction even if your property is going up in value. If your property goes up in value from $250,000 to $500,000, you can still make this cash flow, have this money in the bank, and take this write-off, meaning have a tax break even though you're making more money. But let me give you one more different example to really hammer this point home, because there's a lot of creativity that you can do with real estate, because maybe you want to buy a property for yourself to live in, and you also want to buy a rental property, but you just don't know how to juggle that. Well, according to the definition of a primary residence, when you go to get a mortgage, you're getting a primary residence mortgage. That primary residence can be a townhouse, a single family house, a condo. It can be a duplex, a triplex, or a 4-unit property, which means you could go out and buy this $1 million 4-unit property for you to live in yourself. Now, maybe you can't afford the costs on a $1 million property, but for this example, let's just assume that you're able to find a way to purchase this property. Maybe you can get a low down payment mortgage. Maybe you have the money for a bigger down payment. Let's just say you have the money for a $200,000 down payment here. You're still concerned about how you're going to keep up with the cost, but you had the $200,000 saved up, so now you go out and finance this property with an $800,000 loan. Sure, you could use a smaller down payment, but let's just stick with this example here. Now, you purchase this property, this 4 units, you are going to live right here for yourself. And now what you do is you're going to rent out the other 3 units to your neighbors, who are going to be your tenants. And they're all going to pay you $2,500 a month. So this unit is paying you $2,500 a month, this unit is paying you $2,500 a month, and this unit is paying you $2,500 a month, which means now you're making $7,500 a month in rental income, and you're living in this unit right here. Well, you still have expenses to pay because now you are the owner of the property, so let's go through this. You're making $7,500 a month from your 3 neighbors or tenants that are paying your bills for you. Now, out of the $7,500 a month, you have expenses to pay. You have to pay property taxes at about $1,500 a month. You have to pay property insurance around $400 a month. You have to pay for your maintenance costs. Let's call it $750 a month. You have to pay for your management. Well, now, because you are the manager of the property, you're the one that's collecting rent, I'm going to say 0 because you're actually living in the property yourself, and I'll help you support your cash flow because you're buying this property to generate some cash flow, but also live there yourself too. And then you have to pay for the vacancy costs, or think about the vacancy costs, because you're going to have some time where people are not there, and I'm going to assume 10% of this gross rent, so $750 in vacancy cost. Add up the expenses and you have $3,400 a month in monthly expenses to operate this property. You're making $7,500 a month, which leaves you with $4,100 in net income, which sounds great, but don't forget, now you got a mortgage you got to pay for as well. You finance this $800,000 property, so let's take a look at that. You don't have to get an investor's mortgage. You're getting a primary residence mortgage because you're living here yourself. So let's say you're paying about 6.25% for a 30-year mortgage. It's going to cost you right around $5,000 a month, which means you are going to be losing $900 a month to purchase this property. But don't forget, you're also living here, which means this is effectively your rent cost or your mortgage cost. And this mortgage is now for this $1 million property that you purchase. Now, here's what's interesting. You are paying $900 a month to live here versus your neighbors are paying $2,500 a month to live there. So you're actually getting a little bit of a discount to live in this property because now you own the property, and then it gets a little bit more exciting because now a year goes by. After a year, you legally have the ability to leave this property and rent it out to somebody else. That's what the primary residence mortgage says. So now a year and a day go by, you go out and you purchase a different property, and now you rent this out for $2,500 a month. Hopefully it's in a good area and it can rent for a little bit more, but let's just assume you rent it out for $2,500 a month. Now this $2,500 a month is going to cover this loss that you had, plus put some money into your pocket every single month. And now you are making a profit on this property that you purchased to live in yourself, and now you're making a positive cash flow, and now you have another place to live because you can do this year after year after year, assuming that you live in a property for at least a year and a day. Now, it doesn't have to be a 4-unit property. It could be a 3-unit property, a 2-unit property, or even a single family house that you buy, live in for a year and a day, move out and rent it out to somebody else. And every time you do that, you get to qualify for the lower mortgage, which is the personal primary residence mortgage, as opposed to getting an investor's mortgage. So if you're interested in investing in real estate, but you also want to buy a house to live in, this could be a creative way for you to get started. And if you don't want to do a 4-unit property, again, you can start with a single family house, live there for a year and a day, move out and let somebody else live there, and keep that mortgage in place. And now that tenant can pay for the expenses. And if you do the math right, put some money in your pocket year after year after year. This is a way to get started in real estate called real estate hacking, where, well, it's a creative way to get started. And finally, last but not least, is number 4, cash investments for cash flow. Now, I kept these last because this really isn't an investment. It's a way to generate some interest on this cash then your cash really just isn't sitting idle. Right now, at the time I'm recording this video, the average interest rate on a bank account in the United States is about 0.4%, which is essentially nothing, especially when you compare that to inflation. So if you put this money into a normal savings account, you're going to be losing value, but then some people like to take this cash and put it into a CD, a certificate of deposit, which is going to pay you more than a savings account. At the time I'm recording this video, the average 5-year CD in the United States is paying around 1.3%, which means yes, if you put your money into a CD, you're still going to be losing value to inflation. And then you can consider putting some of this cash into a high-yield savings account. A high-yield savings account is a savings account. They should be FDIC insured. If it's not, don't save your money there. But a lot of these high-yield savings accounts are reputable banks that don't have the same overhead of a physical bank. So instead of driving into the bank branch, it's all digital. But it's still FDIC insured, and it's still a normal bank. You just have to do it all digitally. And at the time of me recording this video, high-yield savings accounts are paying roughly around 4% a year in interest, where now we have some decent interest because the average inflation rate is right around 3%. And if you're generating 4% a year in interest from this high-yield savings account, well, now at least you're not losing as much value as if you were just keeping that money in a savings account. Now, still, in a high-yield savings account, you're not really making much money because inflation is eating away at the value of your savings, and a lot of times the real inflation that you're feeling is higher than the reported inflation numbers, but it's better to get something instead of nothing. And a high-yield savings account definitely beats having a traditional savings account, assuming that it's an actual reputable bank instead of a bank that, well, is not FDIC insured, and now you're essentially putting your money into a scam Ponzi scheme. So definitely do not do that. But if you have some extra cash and you don't want to invest your money, at least generating some interest, whether it's a savings account or maybe even a treasury, that way you can get some interest, is better than not getting any interest. So what is passive income? Real passive income is putting your money into an asset that you don't have to actively operate. And that can mean invest your money into stocks, but that takes more work and more potential risk for more potential return. The alternative to that is to invest your money into something like an ETF, where you can invest your money into a fund that specializes in dividends, or you can get more involved with something like real estate. Now, real estate has the biggest capital requirement, the most money you need to get started, the most time in the beginning. But once you build a good team, now it can be passive because now your managers are going to do all the day-to-day operations, and now you're just overseeing the managers that we don't have to do the day-to-day work. And also some of the best tax breaks, but it is the most difficult to get started. And then if you just have some extra cash, you can look for some extra cash investments while you're waiting for a better place to invest your money. Here, a savings account is going to pay you very little, a CD is going to pay you very little, but a high-yield savings account is going to pay you more, and some treasuries can also pay you more as well. Now again, if you are an investor and you want some more resources, you can check out the investing masterclass that I have for you down in the description. And if you got value out of this video, the best thank you is a referral. So if you could, please share this video with a friend, family member, colleague, or fellow investor. That way we can help spread the financial education. Thank you. Russia accused the United States of trying to devalue its $37 trillion of national debt without informing the American people. How? By using stable coins, crypto, and gold. So if you hold dollars or stable coins or have a retirement fund, you want to pay attention. Why does Russia care that the United States government has $37 trillion worth of national debt?